In this week's update, inflation is not concerning markets. Set and forget your portfolio is dead. Another rotation is building and Bitcoin remains in limbo. My name's Garry Davis, and as always, this is general advice in this video, and please remember to like and subscribe to the video. All right, markets have been waiting with bated breath for the inflation numbers that came out on Thursday night, and we got a very, very different reaction to what we got in April. This has been the key driver of the markets all year, and we've seen a significant rotation away from the aggressive sectors of the market, technology, consumer discretionary, into the more, let's call them the reopening trade stocks, plus financials that would benefit from rising yields. And in April, we saw a fairly poor reaction in equities markets, but this time quite different. So the inflation report in April caused bonds to be sold, which is what you'd expect with inflation expectations rising. The last thing you want to own is bonds. So bonds get sold, yields go up, and that was the normal reaction. And the growth parts of the market, the equities market, was sold off. So that was April. Move on to May. The report, the inflation numbers were equally as significant as they were in April. It was an annualised CPI number of 5%. Should have been enough to really scare the market. It was above expectations. Now, it's a big percentage number because it's comparing to 2020 when things were down. So the number was always going to be big, but it was even bigger than expectations. But the market reaction just couldn't be any more different. And we saw bond traders, and you've got to recognise that the smartest guys in the room are the bond traders in general. They're far closer to the truth than the equities market. And the bond traders immediately hopped in and started buying bonds. Now, if you expect inflation to go up, that is just a crazy thing to do. So the obvious conclusion is that they don't believe that inflation is going to be an issue. And I would back the judgment of the bond market any day over the equities market. So that's the bottom line, that the bond market does not believe that inflation is going to be an issue, that it's going to be a transitory situation. And I think there's probably some clarity around that now that will be the case. So inflation spiked, the equities market didn't care. Technology has really been inherently deflationary over the last couple of decades. It's much harder to create inflation now than it was, say, back in the 1970s, when inflation went well beyond 10% and was a real problem. So it's just harder to achieve, and a big reason for that is because technology is just making so many things much more efficient. Sustainable growth without bad inflation is now far more likely than what the thinking was even just a few months ago. And there are some good reasons for that. And the market expectation now is that inflation is likely to fall back again. So we may get an increase still for the next few months, but that eventually the longer term inflation is going to fall back towards the end of this year or into 2022. And of course, markets are looking forward, the equities markets are looking forward, and so they're pricing on that expectation, not the short term. So if if inflationary fears cause the rotation out of tech stocks and out of the aggressive sectors of the market into the other parts of the market, then what happens now if inflation is not deemed to be a problem? And the obvious answer is that we're likely to see a shift in leadership again, and that the reopening stocks that have done really well this year are likely to lose leadership. And I think it's likely that the money is going to flow back into quality growth stocks, many of which are technology stocks, and I think probably the technology majors will probably do quite well. And we'll see quality growth take over again. I don't think we're going to see a return because it just doesn't tend to work this way. We don't tend to go back exactly to where we were. And 2020 was a year where a lot of rubbish stocks and a lot of highly speculative trades were very buoyant. I think it's unlikely we're going to return to that sort of market. I think you've probably got to be more selective going forward. But you know, I think the good news is that it's highly likely we're going to see a rotation back towards quality technology stocks. So the bottom line for me is that what has done well in 2021 is not likely to continue. I think we're going to start to see a shift. In fact, really in the last week, we've seen that shift already. And the impact is likely to be seen on banks, because if yields are falling, then banks aren't going to do as well. And we've seen banks start to come off a bit in the last few days. Cyclical industrials will not do as well. And some resource sectors of the market won't do as well either. And again, we've seen that those three areas were the three worst performing areas last week. So, you know, whether it's just a short-term blip or not remains to be seen, but certainly it would appear to have, that rotation appear to have started already. But I think the one thing that you can say with safety is that uncertainty is going to remain high, because there's a lot of different opinions out there. And I think our best assets, and I keep saying this very, very regularly, that our best assets are an open mind and the preparedness to take prompt action as we see the shifts unfold. You know, staying on top of the market constantly, because these shifts can occur quite quickly, and being open to them and being prepared to respond to them is the best asset that we can have. Now, the medium-term risks and longer-term risks, I think the main one is central bank policy error, that they either withdraw stimulus or they overdo the stimulus, or they just don't get the policy settings right. I think that is the single biggest risk to the market and will remain so. But also, there's a lesser risk, but it's not improbable, and that is that there is an escalation of conflict with China on all sorts of fronts. So, you know, that could upset things as well. All right, before I jump into the American stocks, let me just look quickly. So this is TLT. So this is the 20-year Treasury bond yield, and you can see it's been selling off since April of last year, or really, I guess, or August of last year. The bond yield has been going down, which means, the bond prices have been going down, which means yields have been going up. But it now would appear that has turned around, and we've now set a new short-term high. And you can see on Thursday and Friday that there's very positive reaction in the bond market. So bonds are being bought, and that pushes the yield down. So I think that's a really key chart for people that watch this video. If you want to keep tabs on things, then keep an eye on this TLT chart, because if this continues to rise and yields continue to fall, then the aggressive sectors of the market, the growth sectors of the market, are really going to come back in spades. All right, turning now to the American market, the S&P ended up 0.5%, and really, other than the first initial 5 minutes where the equities futures fell with the high inflation number, after that it was just all plain sailing to the upside. So the S&P ended up at a new all-time closing high. The best for last week as a whole: healthcare, real estate stocks, technology did well, consumer discretionary did well. So certainly 3 of those 4 areas are the ones that had been lagging all year. The worst had been the former winners: financials, materials, which included steel and aluminium. They'd been on an absolute tear. And also quite a lot of industrials were impacted last week as well. So certainly, as far as last week is concerned, we've seen a rotation, a significant rotation. Now, whether that's sustained or not, we'll know in a month's time. But certainly, it's a very distinct possibility. Now, the US dollar, that spiked back up to 90.6, and the 10-year yield fell from 1.55 down to 1.45. So you remember it ran up to about 1.74, I think, at the peak. But now we appear to be on the way back down again. And the VIX got down to about 15.6. So the market really is, is pretty calm and relaxed about the situation in America. Okay, let's take a look at a couple of, this is XRT. So this is the retail, this is an ETF that covers the broad retail area of the American market. So this covers, not only clothing and accessories and all those sorts of things, but it includes automobiles and pretty much anything that's bought in the economy that goes into this ETF. So it's been forming an ascending triangle, as you can see, and it really does look poised to break out, and had quite a good finish on Friday night. Another strong sector, and this is again indicative, one of the best industry groups, so going down from the sector level down into the industry group level, one of the best performing industry groups on the week is renewable energy equipment, which had just been absolutely murdered. That index had gone from 420 down to 180. So it had lost well over half of its value, but was the best performing sector in the last week. So, these are the signs that there's market shifts starting to occur again, and you need to be alert to them because you certainly want to take advantage. Some of these areas have been sold down very heavily, and the percentage rebounds can be quite stunning. So turning now to the S&P. So there's the long-term monthly chart, but zeroing in, you can see we've had very small range days for quite some time. You've really got to go back to the middle of May, which is when the April inflation numbers came out, that we saw any sort of decent reaction in the market. Otherwise, the small ranges are really, really tight. And this has got the appearance that it's just going to keep going. But bear in mind, underneath the S&P, it's a mix of all of those different sectors, aggressive and defensive. And I think we're starting to see a shift back the other way. Now, another chart that I always keep an eye on. These are the spreads between growth and value. So you can see growth stocks versus value stocks seems to have formed a base here and is starting to move back up within this range. And if we look at, that's the wrong one. Yeah, this is consumer discretionary versus consumer staples. So we're certainly off the peak, but we're starting to see, particularly in the last week, we've seen consumer discretionary outperforming consumer staples, and that's just all indicative of a market that's feeling pretty confident and pretty relaxed about things. There's the US dollar. Pretty much all that move for the week occurred on Friday, and that pushed the Australian dollar down, and we finished at 76.6. So just summarising, the Australian index was up very, very slightly, gained 0.2%. Probably will kick on from that. But again, banks have been a good part of the reason that the Australian index, the ASX 200, has performed as it has this year. But if the current signs are continued, then our banks may now start to come under pressure. And So, we might see a bit of a change in the leadership in the Australian market as well. The healthcare majors were also strong in Australia during last week, and that led the index to the new high. But the best performing broad part of the market was small caps, as we'll see now. The small caps really did quite well. So look first of all at the ASX 200. You can see new all-time highs there. And again, similar to the America, really quite small daily ranges. The market's just not making any big moves at the moment. And the volumes are nothing to get excited about either. So if we just go quickly through the Australian sector indices, there's energy. We had a really big spike at the end of the week before and into the start of this week. There's the banks. They've been consistently tracking higher. Healthcare certainly had a very good week. And there's materials. So materials certainly had a bit of a sell-off a few weeks ago. But there's the small caps. So the small caps have been going very well over the last couple of weeks. And quality small caps are really where the market moving percentages are to be found. Moving on to precious metals now, gold, with a spike in the US dollar, gold lost some ground, and we certainly appear to be in a period now of consolidating the big gains that we've had in the last recent months. The next major hurdle for gold remains at 1960, but we've got plenty of work to do to get back up to there. So not unusual when you see the chart that after the run that gold had, that we would get a bit of a sideways consolidation. And we're seeing the same thing in GDX. So we'll just look quickly at both of those. So there is gold on a weekly chart. So just getting a bit of a consolidation, and you've really got to expect that. We've moved from 1700 to 1900. You've got to expect a little bit of a breather for a few weeks. If we look at it on the daily, we're still within the rising uptrend channel. So that's still looking okay. Silver, really just sort of tracking sideways. I guess in the short term, it's rising. And let's look at GDX. So GDX, similar to gold, it's now back down to the bottom of the trading channel, the upward sloping channel. But it's really done so not by falling sharply, but by really just going sideways and down a little bit. So there's still strength in this trend. Now, if we look at just look at Bitcoin while I think of it. So Bitcoin still in limbo. There are plenty of negatives building up for Bitcoin, and there's certainly some strong rumours around that the US is considering taking action against Bitcoin. Whether that is just a media story or not remains to be seen. But yeah, look, this is a highly unpredictable area at the moment, and some of the schoolyard bullies seem to be ganging up on cryptocurrencies at the moment. Other commodities, copper was steady around $4.50. Nickel edged ahead slightly up to $8.20. Now these base metals, they've been carried by obviously the decarbonisation trade plus all the stimulus that's going on in China is certainly cannot be understated. Yes, we're getting a reopening around the world, and that's stimulating demand, but really the main demand really rises and falls based on what China is doing and how much they're trying to stimulate their housing market and their infrastructure market. Now, the decarbonisation trade looks very sustainable, for years, if not decades to come. But the second, maybe not so, because we've seen in the past, China has periods where it runs for years with huge amounts of stimulus, and then it backs it right off, and that has a significant impact on commodity prices. So I don't just assume that all commodities are going to sustainably move higher over the next 5 years. I think net they will, but there's probably going to be a fair amount of price volatility. Now, crude oil continues to do really well, and it's almost up to $71. So crude oil is proving to be a real contrarian trade. And I must admit I was fairly negative on the possibility of crude oil getting above $70 when it was down in the 40s and 50s. I would have said there was no chance of getting up there. And I've been caught out with the crude oil direction on many occasions. So I find it a difficult one. But my overall impression is that when people are really negative on crude oil, it's probably a good time to buy it. And when they're very positive on crude oil, as things seem to be turning a bit more positive now, then perhaps you want to start thinking about going somewhere else. There's the 1 year spot copper chart. So you can see we've really just been tracking sideways in recent times. But there's the 10-year copper chart. So you can see that we had a huge run up into 2011, and that also corresponded to a huge spike in the iron ore price, in the oil price. But then we got a very significant fall, and the copper price fell quite a way. It fell by more than 50% into the lows in 2016. So if China does back off their stimulus in coming years, don't underestimate the impact that it can have on metals pricing. It can be quite significant. There's the nickel price chart, so just ticking up a bit in the last week. But look, certainly the short to medium term outlook for metals is pretty good. So wrapping it all up, as I've been saying for quite a period of time now, it's really important that your portfolio is full of things that are working now rather than things that may work in the future. It's fine to have some of your long-term favourites in there, but you really need to be focused on what's working now, and that still is the case. So we need to stay on the right side of the trends, but the one thing that you've got to do is to be open-minded and be very ready to shift that emphasis. And it's quite possible that we are just in the last few days in the process of shifting again. And so, you don't want to just think that your portfolio is always going to be structured the right way, and you might need to shift it. So from my perspective, I'm focusing on companies that have got excellent fundamentals. I'm not doing too much at all in the... I've got a few speculative mining stocks, but not much. My focus really is on companies that have got really good fundamentals. They're beating estimates, they're raising their guidance, and above all, they're trending upwards. They've got positive technical setups. So if you keep focused on those things, I think you should be in fairly good shape. Now, portfolio analysts last week, there was quite a bit on taking exits, the trigger signals that I use for taking profits, and it's the single question that I get asked the most is about taking profits. It's the one that traders and investors wrestle with the most. So we did quite a bit on that. How and where to buy after a big fall in a stock that has significant upside from a fundamental point of view, but the price has been going down. We also looked at multiple trading opportunities as well. There were quite a few last week, and there'll be quite a few next week. And I guess my focus will be, now that we've got that inflation data, we've seen the market reaction to the inflation data. My focus now is going to be where's the money now going? Where did it start to shift to on Thursday and Friday last week? So as always, the market will continue to be a fascinating exercise. That's it for this week. There's more information on our website. There's my email address, and I'll be back with you next Sunday. Cheers.